My name's Ethan Braid. Today we're going to talk about long-term stock market cycles and bear markets in particular. We're going to take a look at what has worked as far as investments go in past bear markets, and then we're going to try to get an idea of how likely it is that we might see a bear market in the not too distant future. This graph is the S&P 500 back to inception in the 1950s. What becomes very obvious is that the stock market moves in a defined pattern. Boom, bust, boom, bust, boom. The periods of boom we call bull markets, and the periods of bust we call bear markets. Presently, we're in a bull market, but it may be ending soon. Here's the wide-angle lens view of the stock market using the Dow Jones average back to 1929, 95 years. And you see the same pattern with the Dow as you do with the S&P 500. Bust, boom, bust, boom, bust, boom. Notice that the period of 64 to 82 was a little bit longer for the Dow Jones Industrial Average, 18 years, where the S&P 500 was only about 14 years bear market. And then in the early 2000s, the Dow Jones was a little bit less in terms of time frame for the bear market when compared to the S&P 500. If you are recently retired or getting ready to retire, you are going to want to pay attention to what I'm about to say. Trees don't grow to the moon. The bull market that we're in now is probably coming to an end in the not too distant future. Look, if you just study that long-term chart of the Dow Jones, it is very obvious that we do have cycles in the stock market that are very defined. We go from boom, bust, boom, bust, boom, bust, etc. And the bust periods, the bear markets, tend to be on average a lot longer than the bull markets. So when we transition, not if, but when we transition to the next bear market, you want to be prepared so you don't lose a lot of money and you have a stress-free retirement. Here's what a bear market looks like up close. And I think anyone who is retired or getting ready to retire should pay a lot of attention to this and mentally prepare for what is coming in the future. I started my career in the late 90s, and this was the early part of my career. So I know intimately what a bear market is like. And when you see the stock market fall like it did in 2008 or in 2001, and you watch what happens to people's portfolios, especially those who are not prepared, then you start to understand just how destructive a bear market can be. It can just destroy your retirement. So this is what is probably on the horizon. We don't know the magnitude of potential losses we might see. Okay, that's something you can't predict. But I think that we can be confident in saying that we are going to get some type of sideways bear market with drops at some point not too many years away. There are two major mistakes that retirees make, in my opinion, when it comes to managing their investments during a bear market. One is that before a bear market forms, they're too aggressive. They have the wrong style of equity investments in their portfolio. And two, they sell at the bottom, right? They lose their nerve when the volatility comes and sell at the bottom, and that just completely destroys your retirement. Unfortunately, I've seen people lose their nerve and sell their portfolio out at the bottom during periods of major stock market volatility like 2001, 2008, and the spring of 2020. Rarely does that happen with our clients because we go above and beyond to make sure that our client's portfolio is lined up with their risk tolerance and they understand what the range of returns, gains, and losses is for their investment strategy ahead of time, i.e. before a bear market happens. But there's always going to be some exceptions. You can never bat 1,000. You'll always have one or two people that you just never know what they're going to do when they get scared. And this is the reason that I think some of the maximum value that a financial advisor, investment advisor can add to their clients is to help their clients really and truly understand their risk tolerance, to look within, to introspect, to understand how they feel about their money and connect those feelings to their portfolio. It amazes me how many times I've met people who were invested much more aggressively than they realized. We always want to make sure that we're prepared for a bear market, and especially now, since we've been in a bull market for so long, a bear market is all but inevitable. Here is a look at what worked and what didn't work in the last bear market. This illustration is for a $10,000 investment in 3 different ETFs with 3 very different styles of investments. The illustration is for price only, i.e. appreciation, does not include dividends. I'm going to have another illustration here in a minute to show the impact of dividends, which is total return. The illustration begins with a $10,000 investment in the year 2000, the start of the bear market, and ends in 2013 when the bear market ended. We see that the purple line, which is the Russell 1000 Value ETF, had a total return of about 48% on price over that 13-year period. The orange line is the S&P 500 and finished that 13-year time period with a very small return on appreciation of about 11%. And then the blue line is the NASDAQ 100. And after 13 years, the NASDAQ 100, i.e. growth and tech, was still down 22%. Here's a look at what happens when we consider total return, i.e. adding in dividends and reinvesting them. We're using the same 3 investments, the same time period, but look at our ending values. This is what happens when you include dividends in the portfolio, and why I believe that dividends are a critical part of your return stream during a bear market. We notice that the Russell 1000 Value ETF basically doubled over the 13 years. Great return considering the environment. The S&P 500 had a little bit better performance when we add the dividends in, and the NASDAQ was still well underwater, and the reason for that is there's almost no return from dividends with the NASDAQ. So now we know what works in a bear market. Blue chip stocks, dividend paying stocks, lower PE stocks, i.e. value stocks, tend to outperform, and growth stocks, i.e. tech stocks with no or low dividend and high PE, tend to underperform. Bull markets are just the opposite. Growth and tech tend to outperform during bull markets, and value stocks, dividend paying stocks, underperform. I believe a recession and bear market may not be too far away because the number one recessionary indicator is telling us that a bear market is likely around the corner. What we're looking at here is the spread between the 10-year U.S. Treasury and the 3-month T-bill. Most of the time that spread is positive, and so you'll see a positive spread is going to be the area of the chart above 0. Recessions are gray bands on this chart, and the negative spread, i.e. yield curve inversion, is the area of the chart below 0. And what we can clearly see is that yield curve inversion happens right before recessions, and it's happened before every single recession over the last 60 years. So to sum it all up, the stock market moves in long-term patterns that are very easy to identify. Knowing where you're at in the pattern or the cycle is very important to your long-term success. We may be at the verge of a change in the cycle. There are a lot of indicators telling us that a recession could be around the corner, and that means we'll probably enter a bear market. If you're retired or near retirement, now is the time to review your portfolio and make sure that you understand your risk tolerance, that your portfolio strategy is aligned with a bear market potential, and that you know what to do or how to react, or not react rather. Don't sell out, for instance, once we enter a bear market. I hope this video was helpful. I hope it gets you thinking about your finances and overall improve your family's financial plan.